I think the Fed may be done with their Fed hikes. Is this the shift that we've been looking for? We have been waiting for the employment numbers to come down, and this week we may have seen the beginning of that weak employment reports. Hi, this is Mike Wise with CMG Home Loans and your weekly mortgage update. On Wednesday, the Fed came out with their stance on rate. Basically, they put a pause on raising the Fed funds rate, and they upgraded the economy from a solid to a strong after what they thought was a very strong September jobs report. The Fed is going to continue with what they call the quantitative tightening, along with a very high Fed funds rate, which will continue to be restrictive on the economy. For some numbers, there was a lot of numbers that came out this week. The JOLTS report, which is the Job Openings and Labor Turnover Survey, that showed job openings in September rose from 9.5 million to 9.55 million. And the ADP report showed that there were only 113,000 jobs created during October, which was weaker than the 150 that was anticipated, clearly showing the job market is cooling. In addition to that, the manufacturing report came out and it showed significant weakness on the manufacturing sector. On Wednesday, the jobless claims came in. They rose 5,000 to 217,000, and slowly going, that is a slowly number that is going up. But the bigger number is that the continuing claims have risen for the last 7 weeks. So that is people that lost their jobs, they can't find a new job. They rose 35,000 to 1.82 million. This is a sign that the economy is slowing. So if you've lost your job, you got laid off, it's harder to find a job now. But the bigger number was Friday morning. The U.S. employers added 150,000 jobs in October, which was much lower than the 180,000, which was the estimate. And not only was it the smallest gain since June, they revised the previous months down another 101,000. So the numbers that we saw, which were crazy good for August and September, turned out to be not so good. The unemployment rate went from 3.8% to 3.9%, ticking up just a little bit. The other item that is noteworthy about the BLS jobs report was the average weekly hours worked. So that's how many hours are worked every single week. It came in at 34.3, down from 34.4. And while on the surface that doesn't mean much, earlier in the year, the average hours worked was 34.8, which is now 34.3. So if you extract that extra half hour per week of lost income, when you bring it across 160 million plus workers, you get an equivalent of a loss of 2 million jobs. So that's just by reducing the average hours worked per week. So what was the impact of all of this on mortgage rates? Well, last week we saw the yield on the 10-year treasury at 5%, which was crazy bad news, a high watermark for quite some time. And now we are at 4.52%, so almost 50 basis points has come down in 1 week. The market is basically telling us that they don't think the Fed will increase rates any further. Mortgage rates, they've dropped from 8% to 7.5% in just a few days. This is Mike Wise with your weekly update. I will be around this weekend. If you have any questions, please give me a call, shoot me a text. I'll see you next week.